Welcome to It's the Economy, though this is actually more markets than macros. PSUs have been the rage of the market, and today we discuss PSU banks. Most of them have risen between 100 and 160% in the past 12 months. Just look at the table running by. Motilal Oswal has come with a fresh report on Feb 26th, reiterating their overweight stance on PSU banks and actually picking half a dozen as their favourites. The report argues why the PSU bank run has more juice left. And so I suppose you should hear out the author of the report, who is with me now, Nitin Agarwal, the head of Banking Financial Sector, BFSI Institutional Research, Equities at Motilal Oswal. Nitin, good morning, and thank you very much indeed for sparing time. It's a really interesting report, so filled with data. Let you speak for yourself. Why do you think the PSU banks are a good buy?
Thanks, Adan. Good morning to you and all. Of course, see, last few years, PSU banks has been reporting a very strong performance, and that is completely backed by earnings and the way the asset quality has improved. So from a point in time when the GNPs were very high, today, if you look at PSU banks are going to broadly reach the levels of net NPA of private banks by FY24 end. And by FY26, we are estimating the net NPA levels to be similar between the two segments. And the valuation arbitrage was very considerable, which with this rally has seen some bit of narrowing. But still looking at the outlook wherein we are still expecting these banks to deliver 18-19% ROE over the coming years. And even the earnings growth is likely to sustain around 20% CAGR. And though this is to some extent getting a boost from banks like PNB and SBI, which are having a relatively benign base, but other PSU banks also we are expected to deliver 17-18% earnings CAGR, and which is where we believe that the rally overall in the sector will continue, and the valuation at one-time book, which is where they have come out on FY26, still appear reasonable in context to that overall balance sheet strength and the profitability outlook.
Okay. Your arguments are much more convincing, and many of your numbers in your report are running as you speak. But is there more juice left? That's the question people will want to ask. Like we just pointed out, 100 to 150% rise in the past 12 months. And most of them, by your own reckoning, adjusted book value, price to adjusted book value is one time already. Historically, it hasn't gone beyond that. So you still think there's juice?
I think the return expectations have to be calibrated, of course, and which is where if you see even in our report, we have put out an average upside of around 15-17% for these banks this time. If you look at our own rating and targets in the prior 3 years, we would have written notes ranging between 25 to 40% upside on these banks. So first and foremost, yes, the return expectations have to be calibrated. But when you look at what is impacting the sector as of now, the private banks all are facing some overhangs around CD ratios, which are stretched for them, margin compression cycle, which is continuing, and the normalization in credit cost, which is what everybody is staring at as to what pace it can happen and how soon it can happen and to what level the credit cost can rise. Because there is a very extreme behavior on credit cost by certain lenders who are already witnessing the normalization in credit cost. So which is where you are watchful on private banks as a whole. But PSUs, they have ample liquidity. Their MCLR repricing will continue, and therefore, to that extent, they will relatively do better on margin front. And asset quality, barring SBI, if you look at the other banks, they are still fairly high on credit cost. So for them to move up further from there, it's still not our base case. We still believe that with overall recoveries and upgrades from the back book, which is like the high quantum of TWO return of asset pool and the GNPs that they still have, can still make up for a pretty good number versus the slippages that you're looking at. And which is where the credit cost overall will remain in control for these banks. And for these reasons, we continue to like the sector. And so what is limiting the rally from here for them probably is one fact that private banks as a space overall has derated very considerably, with many banks trading now between 1.4 to 1.7 book. So which is why PSUs at one time definitely looks like that there is a very narrow gap now that you're looking at between PSUs and private versus probably all these years in the past. But looking at how the performance is going to be for these banks, I think there is still money to be made in these stocks.
Okay, so what you're saying is that in the past 3 years, as you point out, the PSU banks, or 3 or is it 4 years, PSU banks have actually trebled in terms of prices, but private banks rose by what, 43% you have said, in terms of prices. Going forward, you think private banks are likely to rise a little faster than PSU banks?
I think there will not be a very big gap between the two segments,
Okay,
but
okay.
PSUs, because they are not having any of these challenges to go with from here in the immediate quarters, they will continue to do well as a space.
Okay. Okay. So there may not be much to choose in terms of the price rise. Okay. Now that I have you with me, what's your sense about HDFC Bank? Is it now bad enough to be bought or stressed enough to be bought? Or do you think it will linger at these levels for a long time? The price correction, the time correction will be there before the prices rise?
I think the stock has seen a fair degree of correction in this quarter alone. And as the bank now delivers on some key metrics around the deposit progression and around margins, of course, while we are not expecting any meaningful improvement in margins in the near term, I think it is going to be a long journey for them to come back to 4% levels. But any stability around that front is something that would be watched keenly. But from a price point, I think the stock trades at very reasonable level at around 1.7 times price to book on 26 and 10 times earnings. So that looks fairly attractive, and we still like the franchise. We believe that while last 1 year, especially post-merger, things have not been moved really in the right direction as such. But there is a strong franchise that HDFC Bank, of course, has. And as this reports some bit of traction on deposits and some of the other key metrics, I think the stock, therefore, should start yielding a positive returns in the coming months.
Okay, okay. It's just that the weight is getting, trying patience. Coming back to your report, you have recommended SBI and Union Bank as your top picks. If you can tell me why, and why not Canara Bank? Because by your own analysis, the ROE is highest for that bank.
Yeah, certainly. So, see, SBI certainly is because what we are seeing right now is a cyclical upturn in the sector. If you look back, and while the valuation history last 8-10 years will not be a right reflection, because the levels of net NPA, the strength of earnings in terms of ROE, what we are looking at is something that has not happened before in the last 10 years for these banks. And therefore, the valuations, if you look from the lens from the past angle, you will feel that the valuation multiples are constrained for these banks. But looking at that with the possibility of this government coming back with the overall corporate cycle, therefore strengthening further and capex demand also reviving, which is where PSU banks have the ability and the history to lend. And they are doing a fair good underwriting job as of now across segments. So that can drive up the numbers and growth for these banks and further reduce the differential in terms of loan growth versus private sector. One of the interesting points that we have mentioned in the report is, if you look at the last 3 years, 3 and 4 years, the market share loss for PSU banks have narrowed considerably. They were losing 600 to 800 basis points to private bank in every 3 to 4 year block. That market share loss has reduced to less than half in the last 3-4 year block. And that's something that we expect to further narrow down to private banks in the coming 2 years.
Okay, okay. Any word on Canara Bank? I mean, why is it not up there, considering that the ROE is so much better? It seems to be an underappreciated bank for me.
Yeah, it has been, yes, I agree to that. And which is why, if you look back to our reports, we have been pitching Canara as amongst our top buys. And in fact, the price target that I wrote on the third quarter results in January, that which was almost a 22% upside, that got met in February. So it's only because the run-up has been very sharp and we've been marketing the stock right from 200 levels. So we have therefore not kept a top buy on Canara in this report, and rather for Union, wherein we believe that it's relatively cheaper. And the earnings progression for Union, the asset quality normalization is also happening almost on the comparable lines. So which is why we have went ahead for SBI and Union in this report as a top idea.
Okay. A lot of people may want to book out considering the excellent profits people have made, provided, of course, they entered a year ago. There would be a bit of a desire to book out. What is your sense about the longer term performance? Let me tell you my memory as a banking reporter. I probably began in the late 90s and saw the cleaning up of the banking system, all those public sector banks coming to the market, the big steel cleanup when Jindal Ispat and Essar were restructured. I saw through all that period, and then the good times lasted almost from 2003 to 2013. So do you see a good 10-year run for PSU banks? Probably 2 or 3 are over.
I think that's quite a possibility, because the way things have shaped up for these banks, the intent that is there both from the management and as well as from the government to maximize the value of PSU enterprises. And this rally is just not limited to PSU banks, as you know. This is like penetrating across all sectors. And there could be some further reforms that can happen in respect to PSU banks that will drive further interest in these stocks. But of course, these are relatively longer term things. But over the next 5-10 years, as you're asking, there is a possibility that these PSU banks can continue to do well because overall underwriting for them has improved. One very interesting data point, if you look at the SMA numbers over last 4 to 6 quarters, there used to be a very wide gap between PSUs and private banks 3 to 4 years back. In last 4-6 quarters, the gap has just been very sticky and very narrow at around 10 odd basis points. So that means PSU banks are doing as good a job as on underwriting as a private bank. The SMA numbers also are reflecting that, which is not changing versus private banks.
Okay.
So,
Okay.
and that indicates that asset quality cycle for them will remain on the positive side, and which is why there is a possibility that on credit costs, certain banks like PNB, Canara, Union, they may go down the curve further in FY25.
Okay. Okay. Point taken. Clearly, in terms of asset quality, the entire ecosystem has learned a lot. You know, you have the CRILIC database now. You have the SMA monitoring now. So, and perhaps hopefully expected credit loss will also come in a year or two. And that should perhaps put in these institutional mechanisms against asset quality deterioration. But I have my own fears on how they will take up the fintech challenge, which private sector has taken on very well. Coming to fintech, your words on Paytm. Where do you all stand?
I think, of course, the regulatory restrictions has really affected things, and the stock price reflected that. And of late, it has been trying to find its feet, and given that it's going to take them some time to ensure that the business comes back towards normalcy. There is no leakage of business, as in they shouldn't really lose any merchants, any customers in this transitioning process, and the business growth should come back. So, which is where all these uncertainties are playing heavy on the stock as of now. While we believe that, of course, there is a definite value to the entity because ultimately they have a very large transacting user base, almost 10 crore monthly transacting users they have, and a fair bit of share in the overall GMV and amongst the sizable players in the overall UPI spends. So there is an inherent value that is there in the franchise. And as the stability comes and they are able to tie up with banks and handhold this transition further with ensuring minimum leakage, I think one can see some stability to positive returns in the stock in the coming months.
Okay, yes, and they have a lot of cash as well. That itself, I believe, gives about 170 rupees to the stock. So perhaps they can make good. And my colleague Nimesh was pointing out that in many of the previous cases of difficult banks, when the management changes, normally that's the bottom and banks do well. So anyway, that was Nimesh's point of view. Thank you very much, Nitin Agarwal, for joining us and handling a range of questions on the entire banking and financial space. The key message being that there is juice left in the PSU banks, even after this wonderful rally that these stocks have seen. The pick for MOFSL being State Bank and Union Bank. That's their top buys. Okay, with that, we